Great job, guys. So I want to understand your thesis a little bit better. I understand they can get growth in some of the international markets, but it's primarily domestic. You say the domestic market is saturated in terms of casual dining, and so I'm trying to understand, the competitive factors that are going to drive that 7 to 9% growth, and what research you did behind that. Did you visit the restaurants? Is the food better? Is it better? What's driving that? I've eaten at Carrabba's and Outback, and in my view, the food is kind of mediocre.
So we did plenty of due diligence.
More than we should have.
No, so they're driving it. The domestic market is saturated. There's more competition here than anywhere else in the world for casual dining restaurants. They're addressing it by going abroad and finding those locations that are higher margin, but then domestically, they're finding a site or they're renovating. They're changing their real estate. They have the financial flexibility that some of their competitors don't to find those A site locations, those real estate locations where traffic is really going to benefit. And then the renovation side has led to 20 to 40% upside in the short term. And that usually costs them about $1 million to renovate each site. And then Carrabba's, they're changing menu options. They're making them lighter, things like that.
Yep.
And additionally, the domestic growth is driven by Bonefish, which is the smallest of the concepts so far. It's a smaller restaurant, so it costs less to build. Typically has a little bit higher margins, we believe, although they don't break it down specifically. And Carrabba's is being scaled back just because it's lower margin.
Yeah, I think management really understands the portfolio concepts very well, and they're really responding to what's going on in the market for those different types of concepts. So Italian is more of a special event type of food item, and that's been hurting them in the past. So what they did is they came up with a simpler menu for Carrabba's with lower prices, whereas they're doing kind of the opposite thing in Outback. So management's taking the flexibility, and they're realizing that some concepts they're going to have to approach from a different perspective, and in doing so, so far they perform very well.
Additionally, domestically, Bonefish has much higher alcohol sales as a percentage of sales, which tends to be much higher margin as well.
I have a question about the debt repayment acceleration. I think I heard you say that this will lead to improved margins that the rest of the market does not recognize. Why do you recognize something that the rest of the market doesn't? And tell me a little bit more about what they're missing.
Sure. So the company refinanced its term loans that were left over from Bain back in October, and with that came amended credit agreement. And one of the covenants of the amended credit agreement states that the company must prepay 50% of its excess cash flow, as described as operating cash flow less capex, until it gets leveraged down below 2.5 times total debt to EBITDA. So what we did during our research is we went out and looked at a lot of the sell-side models out there to see, what type of debt paydown was being forecasted. And I mean, one of their term loans has a balance of $300 million. They're contributing significant amount of cash flow to pay that down, and a lot of the models either had absolutely no amortization of that debt or very, very limited amortization at a fixed amount moving forward.
Additionally, whenever management talks about their target debt to EBITDA ratio, they've never actually mentioned that they have to pay down this cash flow, although it is in the covenant. So they just kind of tell everyone it's a target, and if you want to go do the work and find it in the 8K, you can.
I'm confused. Leverage, you said, is going down. They're buying back stock. Is it up? Is it down in the future? And two, they have business risk. What is their business risk, and how does it match their financial risk?
Sure. To address the first question, so what they're doing is they're taking that excess cash flow, so operating cash flow is less capex. Half of it is going to be distributed to shareholders either through the dividend that the company initiated in January or buyback, which they have $100 million approved, $70 million of which has been completed as of last week. And the other half is going to prepay that debt. So until they get leverage down below 2.5 times, that's going to be the case. So I hope that addresses your first question.
So the leverage is going to decline?
Yes.
Okay. And how does this leverage level at this point compare to competitors?
Well, currently, I mean, a lot of it is just leftover leverage from the buyout, and they do have leverage levels that are above their competition, which is why we think the company currently does trade at a discount. However, as they do pay down that debt and they do get leverage down to peer levels, which we can see happening even as early as the end of this year, beginning of next year, we think that that's one of the reasons why we see the multiple expanding.
And the business risk to financial risk?
Okay, so I mean, right now we project that they're going to have more than enough cash flow to address their leverage and to service that debt moving forward. The combination of how the business has performed in the past as well as their future prospects, we don't really see leverage as a huge risk.
In terms of business risk, I think you're asking a little bit more.
The asset side of the balance sheet.
Go ahead.
So they have some real estate assets on the balance sheet. I'm not sure exactly what you're.
Could you clarify?
Is it a cyclical, non-cyclical? Are they at the risk to
It's
recession?
a highly
Okay.
cyclical
They won't-
business,
Uh-huh.
driven by consumer sentiment and consumer spending. Obviously, they've performed pretty well in the past couple of years as the consumer has kind of rebounded in the United States. Obviously, a threat to that is the Brazilian economy is not doing too great right now. However, in Brazil, it's highly ingrained in their culture to go out and eat food with your friends. It's a very social culture. So you don't tend to see as big fluctuations as consumer spending in terms of restaurants in Brazil as you do in the United States.
So I apologize for not addressing that question earlier, but the main point is they're going to face fuel costs, they're going to face beef costs, potential risks like that. Definitely Brazil, there's political instability there. But the main risk that any restaurant faces is, can they pass these costs on to the consumer? I think that's the crucial point, and how will the consumer react? And that's the biggest risk to address going forward.
And regarding the Brazilian operation, you said that, I mean, as far as they don't repatriate the money that is invested there, there's no risk. But considering revenues, there is a risk of depreciation of the domestic currency. What does the company do in terms of currency hedging or exposure?
They do not hedge currency risk.
I'd like to know a little bit more about the valuation methods you used. Could you just recite those for me again? I went pretty fast. I'm sorry, I'm a little bit slow. So,
Sure. So we relied.
These
Go ahead.
are all different models here that you employed, all those bars?
So what you're seeing on the top is our REIT valuation, followed by our adjusted present value valuation, and then we have comparable companies analysis as the next 4 levels. So that's just different multiples that we use, different metrics, followed by our discounted cash flow analysis.
Well, surely there's 1 or 2 of those that are more usable in the industry than all of them, right?
That's correct.
How are you weighting them, and why are you relying on all of them having a little bit of influence in the valuation?
Sure. Well, we considered mainly our comparable companies analysis. That would be using an enterprise value to EBITDA multiple, as well as our discounted cash flow analysis. So we looked at the valuation we got between those two and kind of took a mean.
So I'm going to go back to my question in terms of the due diligence. I didn't quite hear an answer. You said that you did a lot of due diligence, but what did you see at the restaurants that convinced you that this company has a competitive, in fact, perhaps even a superior product vis-a-vis other casual dining restaurants in their markets?
One thing that we noticed about the company is one of their current cost initiatives, the $50 million a year they're trying to save, is that they're using IT to optimize their labor force. And we did notice when we went to the companies, there were never any waiters or waitresses standing around. Everyone is always busy running back and forth between tables.
I mean, just a lot of efficiency in the operation, and kind of back to the point that I mentioned earlier, that management says they want to be excellent stewards of capital. We've seen them doing that thus far. On their last earnings call, they were just talking about addressing how the company is looking at the different niche industries within the consumer dining industry that they're currently in, and how to address the specific trends in those industries. And I think just listening to how management is doing that made a lot of sense to us, was something that we found to be a very positive thing. And going out and seeing the restaurants, I mean, most of their portfolio concepts are almost always full. They're restaurants that people always go to.
And part of your forecast calls for rising margins on the business. You talked a little bit about the improved efficiency with IT, but talk about some of the other cost factors, the food costs involved, labor costs, you mentioned higher minimum wage. How are they going to get a higher margin given what your forecast for some of the costs?
So, they don't really forecast a lot of those costs rising substantially moving forward. A lot of what we're looking at is how they can cut the costs that they have a lot more control over. So less of those commodity costs and more, how they look at labor and how to become more efficient, how to run their operation in an efficient manner to keep margins up.
A lot of it additionally is the fact that they're growing faster in Brazil than in the United States. So it'll just therefore be a higher weighted average towards Brazil of the 10% margin versus the 5% in the United States. And in the United States where they are growing, it's with bonefish, which tends to be a little higher margin.
Time.